I wonder if we go through, if we go through the market narrative that we saw yesterday. It's been a while since we've seen that kind of weakness. Is it something that we should be scared of medium to longer term?
It's the right question to be asking, especially after, the string of days that we had significant up days, largely driven, I think, by some really fundamental excitement about earnings and, going past the trough and into what looks like a much more favorable earnings cycle in comp. But look, I think what happened yesterday was a little bit of this 1-2 punch where not only did we have the Fitch downgrade sort of highlighting something that we all really know and is in the back of our minds as U.S. citizens and U.S. investors, but you also had that second punch of Janet Yellen coming out, not only commenting, but talking about increased issuance. And look, there's reason to be concerned. There's been really a Boolean optimism, not only in the narrative around the market, but also in the positioning around the market. For the first time in a few years, hedge fund managers are really all in. And that's a little bit because of FOMO, a little bit because of just market momentum and really being forced to cover shorts, and a little bit about, you just can't miss the AI trade and what that puts in the market. So we're really at this point right now where we are priced to perfection, just starting August, which tends to be a pretty volatile month. And we don't have the Fed speaking for a couple. Well, we have Jackson Hole, but we don't have any Fed meetings or decisions for a while. So I think we're probably likely to see a little bit of volatility, which, is okay in the market.
All right. So volatility is OK, but we just are not used to it, Allie, right? Because we haven't seen it in such a long time. So that brings us, Allie, to your word of the day. What is it in your mind, given what you've just laid out for us?
Precarious. I think in terms of this priced for perfection, and as you can tell, I use a lot of alliteration in my investment conversations, but the way that the market is priced right now is really assuming that three fundamental things happen. One, the AI trend continues to accrue to stocks, and not only the top 7 or 10, but really everything. Two, the rate cake is baked. We're done. And we're going to stay here for a little bit. Data is going to capitulate, and then we're going to, start to see the other side. So peak rates are behind us. And three is that the consumer can remain this resilient. And as much as we keep talking about, again, this consumer resiliency narrative, it is true that the long and tenuous effects of interest rate policy are going to start to catch up with us. And you're starting to see headline stories like, people are not interested in paying back their student loans. Yesterday we had some, soft ISM manufacturing numbers. You can't avoid a recession forever, but we can kick it down the road and we can make it potentially like the earnings recession, very low key, and then start to build again.
All right, Allie, we just got a few moments left here before we let you go. What are your favorite parts of the market, given that narrative?
You got to go with the things that haven't worked as well, but fundamentally should. You got to go with defensives. If you believe everything I just said and you're investing in equities, you have to believe the rate cake is baked. You got to lock in, 1 to 5 year yields in bonds. And with value underperforming by an epic sort of historic 24% under growth, you got to get there as well. You got to go for where the money hasn't been. And, and courage and cash in a crisis, a la Warren Buffett, is priceless.